Hi, welcome back to capexforextrading.com. In this video, we're going to discuss the main differences between three types of forex broker: the ECN broker, the market maker, and the STP broker. Now, ECN stands for Electronic Communications Network. Market makers are brokers that make their own markets, and STP stands for straight through processing. Now, we're going to discuss what all of those three mean in just a second, but you're going to find this video especially useful if you're new to trading, because you're exactly the type of person that will get sucked into by untruthful marketing campaigns conducted by forex brokers. So you will see things like offers for low spreads, no commissions, and traders seem to sign up to these things because the offer sounds really great and it looks like your trading will be as cheap as possible, because, you know, let's face it, who wouldn't want to trade if a broker offers really low spreads and no commission? It's a great offer. The reality is that you're the type of trader that is going to get burnt in the long run. The reason is because it is this lack of knowledge on your part that these brokers actually thrive on. And I'll explain exactly what I mean by that. So what we've got in front of us here are two charts. We've got chart number 1 here on the left and chart number 2 on the right. They are exactly the same currency, which is the Euro USD in the 1 hour time frame, the same that you can see here. The only difference is that they're from two different brokers. So I've minimized this window here, which I can't click because it will make one of the charts disappear. But so you need to follow my arrow. So we've got broker number 1 here on the left, and we've got broker number 2 here on the right. So at a quick glance of these two charts, we can see that they look pretty much the same, right? So we've got a downtrend here and a new uptrend here. We've got a downtrend here also and an uptrend here. Now, if we look at the prices that are being quoted, I'm only going to refer to the last two digits. We've got 84 here on the left, and we've got 77 here on the right. Now, you'll be wondering, well, surely, or you'll be asking a question rather, well, surely, no matter which broker you go to, the prices charged for buying or selling a currency are exactly the same. And that's a fair question, and the answer is yes, it should be like that, but it's not, unfortunately, in the forex industry, and I'll explain exactly why that is. Every time that you buy a stock, the price of that stock will be the same no matter which broker you bought it from. The reason why is because the stock market industry is heavily regulated and the prices are derived from one central exchange, such as the New York Stock Exchange. In the forex market, it works slightly differently. The prices are not derived from one central exchange. Instead, they're derived from something called the interbank market. The interbank market is a conglomerate of various banks and large hedge funds that provide prices for currencies to various different brokers all around the world. Now, the prices provided to these brokers will vary depending on the relationship between themselves and the broker. So obviously, the better the relationship, the better or the cheaper the prices. Now, for the sake of this example, we're going to assume that the interbank market is always made up of the same players and that the prices provided to all different brokers around the world are exactly the same. So for the sake of the argument, let's say that the interbank market is quoting a price for the Euro USD currency pair at 1.4 thousand over 1.4 thousand. Now, for those of you who don't know, the difference between the buying price here on the left and the selling price here on the right is called the spread. Because there is a 1 pip difference between those two prices, we say that this currency pair has a 1 pip spread. So the interbank market is quoting and providing a 1 pip spread for the Euro USD currency pair to all different brokers around the world. Now, those different brokers will be the ECN broker, the market maker, and the STP broker. Now, the ECN broker will take this 1 pip spread derived from the interbank market, and they will add another couple of pips on top of that to make a total of 3 pips. Now, the price that they're quoting is 1.3999 over 1.4002, so it's different to that of the original interbank market cost. The reason why is because they've added a 2 pip profit on there, so they've widened the pip spread you see in the middle here. And that's how they make money from you, so that's fair. The market maker will do exactly the same. So they will take this 1 pip spread, but they will undercut the ECN broker by adding only 1 pip up top of the original 1 pip spread. So the total here is 2 pips. So they will quote this price, which is different to the original Interbank price, but it's also different to the ECN broker's price. And this is why the prices varied, or the prices were different in the 2 charts that we were looking at earlier. The STP broker has a mixture of both. So they will provide a 2 pip or a 3 pip spread to various customers depending on their success rate. So they kind of get the mixture of both worlds. Now the ECN broker will provide true market conditions. So despite the fact that they're slightly more expensive, the actual market conditions supplied by the interbank market will be exactly the same trading or market conditions supplied by the ECN broker. And that's fair. So far, they're quoting you fairly and they're providing fair, true market conditions. Now, this is where the game changes. The market maker, despite the fact that they're cheaper, they will not provide true market conditions. In fact, they will manipulate market conditions in their favor. And they'll do this in a couple of ways. Number one, let's say that you place a buy trade with a profit of $400 at the profit target, and you get that trade and you hit your profit target and you generate $400. The market maker will also place the same trade into the interbank market, and they will also have a $400 profit. So when you get your winnings, they won't have to take any money out of their accounts to supply these winnings for you. Essentially, they will take the winnings from their interbank market account and transfer it into your account. And the only money they'll probably make is on the commission that they've charged you if they wish to do so. The second way is by using something called the virtual dealer plugin. Now, the virtual dealer plugin is a piece of software that allows brokers to trade against you either manually or automatically. Now, for example, let's say we're talking about the exact same trade where you hit buy and if you win, you will generate a $400 profit. Now, every time that you do this, or every time that you trade, you're putting your broker at risk. So it's within their interest for you to lose, because the risk can be so great if you're really successful. So they have to find a way to manage that risk. And the way that they manage this risk is by placing a trade opposite to you. So every time, so what you'll see, for example, is your buy trade going up and up and up and up. And then finally, just before it's about to hit your target, you will see a big dump in the market and it will go against you and you will be stopped out. This is prime evidence that the market maker is using virtual dealer plugin software. For example, you may see a difference between the demo account and your live account. For instance, you are really successful in your demo account and you use exactly the same strategies in your live account, but all of a sudden you start making big losses in your live accounts and you see big spikes in the market in the opposite direction with no real economic data coming out. So this is just pure evidence that your market maker is trading against you either manually or automatically using the virtual dealer plugin software. Now, the reason why they can do this is because of this lack of regulation. You know, it is getting better every year and the regulation is getting tighter and tighter. So you must just do a bit more research when looking for a market maker broker, because they can trade against you. They haven't got your interest at heart. So I'm painting quite a bad picture of market makers here. That's not the point. There is a lot of market maker brokers out there who are great and they really do have your interest at heart. It's just that there are the odd few with offices in strange countries whose regulations you're not even aware of that can trade against you. So just be slightly more careful. The STP broker, again, does a mixture of both, but it really depends how good you are in terms of which bracket you fit in. So if you're a bad trader, if you're not very successful, they'll probably make the market for you and provide you with a low pip spread, but put you in a manipulated market condition where they'll make you think that you're winning one day and then the other day they'll just trade against you. If you're a good trader, they might stick you in the true market conditions, but they'll widen the spread a bit more to ensure that they get as much profit from you as possible. In fact, they might even do the opposite depending on their business model. But whatever the case is, the STP broker, because they get the best of both worlds, they'll have various algorithms or people who manually look at trading accounts and see which bracket you fit into. Okay, so what we've done for you on our website, just to make it a little bit easier for you, is provide a list of trusted Forex brokers. So if you go to capexforextrading.com/Forex-brokers, or simply go onto our website and then click the Forex Brokers tab, by scrolling down, you will see a list of trusted Forex brokers. Each one of those brokers will have a link where you can open a live account or a demo account, depending on where you are in terms of your trading stage. The list is getting bigger and bigger, and we are putting a few brokers on here on a regular basis, so hopefully you will find the one that's suitable for you. We are declining a lot as well, because there are a lot of brokers who are getting in touch with us, but we're declining them because they're just too much of a market maker, and that's not the type of broker that we want you to trade with. So have a look at the table. It's completely up to you. Click to either open a live or a demo account, and hopefully you can make a profit by trading with them. Okay, so that concludes this lesson. If you can subscribe to us on this channel, that would be great. Also, if you can follow us on Facebook, Twitter, LinkedIn, or Google+, that would be great. And we shall see you for the next lesson. Thanks.